Welcome back. Right now, we're going to start a new topic, variable costing and segment reporting. And for this particular topic, we're going to explore how variable costing behaves using contribution margin format income statement that by now you're completely, hopefully, familiar with through managerial accounting, and how it's affecting segments of the business or different departments. I'm going to share with you my screen. And we're going to jump into presentation. So variable costing and segment reporting, and I actually kind of try to be clever here. So it's our tools, and we have a little toolbox here for management, how to use it internally. Before I begin, I kind of want to mention this right from beginning. Not every company would have a managerial accountant internally on site. The cost of internal accountant and analysis that you do have to outweigh benefit, right, or cost of paying their salary of information they're deriving from it. And some companies, unfortunately, might not be able to afford to do that, and they might employ internally people who do regular reporting for GAAP requirements to do some of those reports. And we'll talk about those aspects. But again, not every company might be able to have a managerial accountant on site because benefit of having one should outweigh the cost of it. All right. So the first objective, we're going to try to understand the difference between variable costing and absorption costing. Before we even start, I want to mention that variable costing is not something GAAP or IFRS are accepting. Absorption costing is what the requirement is for general accepted accounting principle. So we're learning variable costing, and we're going to look, compare, and contrast how different they are. But variable costing is really a tool, and it's something you would do for internal purposes only. So this chapter uses actual costing than the normal costing approach that was used in job order costing chapters before. This topic also uses actual number of units produced as an allocation base of assigning actual fixed manufacturing overhead costs. So sometimes you would not know what you're going to produce. You're obviously going to use budgeted numbers. So we're making those assumptions to simplify the concept. So this is kind of disclaimer how we're approaching this. And this chapter always assumes that variable and manufacturing costs per unit and total fixed manufacturing overhead costs per unit remain constant, which means they're not changing. So that's kind of three assumptions that we're using as we're looking at this chapter to understand the concept. And again, in this chapter, I would be using examples to get the point across of the concepts. And as we're doing this, I'll intertwine the concept definitions and understanding. So let's take a look. I like this chart a lot because it's visually really contrasts what's happening here. Under variable costing, which we're learning in this chapter, a product cost includes only direct material, direct labor, and variable manufacturing overhead. Under absorption costing, you can see we have one more cost that we grab for product cost, which is fixed manufacturing overhead. And this is GAAP. This is required by stock exchange, whoever you have official GAAP requirements that needs to be reported to, this cost should be included. And period costs that we already talked about it, right? Administrative costs, marketing costs that are fixed and so on, not per unit, would be actually put into the period cost right here. So as we're moving through this, I want you to be able to kind of rewind to this part and always say, okay, what am I capturing? Only going to stop short of variable manufacturing cost. So with that, not further ado, we're going to look at different examples throughout this presentation and see how this one line, fixed manufacturing overhead, affecting overall performance and presentation. For this example, we're going to use the number of units produced annually of 25,000. So produced and sold could be different. So we have to remember that. Not everything you produce you would actually sell. We also have direct materials, direct labor, and variable manufacturing overhead is $10. So if I go here, this product cost right here, right, is this number of, oops, this number. Oh, it's playing with me here. I actually want to do the pen. So $10 is that cost. Now, my variable selling and administrative expense is $3, okay? And as you can see from here, right, variable selling administrative expense under both methods, it's a period cost. So now we have manufacturing overhead of 150,000 and selling administrative expense is 100,000. So this is manufacturing overhead and my selling administrative expense is right here. So this is the data that is given to us. Again, this is a good time to have a notebook maybe next to you, jot those numbers down because we're going to keep revisiting them, or you can rewind the presentation. Okay, so under absorption costing, which is required for outside external reporting, we're going to use $10 of direct traceable cost. Well, traceable is going to come through it. Direct cost, direct labor, and variable overhead of $10. And then we're going to take fixed manufacturing overhead of 150,000. This is our total, divided by 25,000. And under these circumstances, remember the three assumptions we made. We're going to assume whatever we produce, it's what the cost is $6 per unit. So we're actually allocating our fixed manufacturing overhead per unit. This way, we capture all of the cost in the product cost. Now, for variable costing, we're not going to use fixed manufacturing overhead, and we're going to leave it out. So here, under absorption costing, all product costs, variable and fixed costs, are included when determining unit product cost. Under variable costing, I'm just reiterating this, only this part is included. So now we're going to prepare income statement under both of the methods. We have additional information available to us. It's kind of adding into the problem. We're going to assume that 20,000 units were sold during the year. Remember, we produced 25,000 units and we're selling only 20. And we sell them at $30 each. So that's our sale price. And there's no beginning inventory. So we're going to compute using both methods. We'll take one at a time. So under variable costing, we have 20,000 units at $30, $600,000 sales. Now we have our $10 cost per unit, 20,000 times 10, 200,000. We have variable selling administrative expense, and that is 60,000. So my total variable cost is 260. I'm using contribution margin approach income statement here. So I have $340,000 contribution margin, less my fixed expenses, right? So fixed expense, all of the fixed expenses. Do you guys notice how this cost is not included in here, right? Because it's fixed cost. So fixed cost of 150 and fixed selling administrative is 100,000 to 50. My net operating income is 90,000. So under variable costing, this is our final numbers. Now, under absorption costing, again, we're reporting, you can even see this is not contribution format income statement. This is our standard income statement that we produce for GAAP requirements. So sales 60,000. Now cost of goods sold includes that $6 of manufacturing overhead that we determined in a previous slide. So sales of 600 minus cost of goods sold of 320. Our gross margin is 280,000. So under this, again, it's only 20,000. That's what we made. Less selling administrative expense. So we have variable cost of 20,000 times 3. So we have to include that because remember, it's a period cost. Plus our fixed cost of 100,000, which is period cost, gives us net operating income of 120. So now you say, whoa, what's going on here, right? We have 90,000 here under this method and 120 here. I do like having my pen, but I don't know why it would not stay all the time. Would be nice, right? So 120,000 is my net income. And the difference is due, I'm just going to tell you this right now as I'm going through sites. The cost we're using here is $16, not 10, right? So let's reconcile between two. This is in the same place. Now, whatever we sold is cost of goods sold, and it's going to go to income statement. Whatever we have left, right, is going to be an ending inventory. And as you remember, we have 5,000 units sitting in an ending inventory. So under cost of goods sold, under variable costing, we had $200,000, and ending inventory would be $50,000, because what we have here, right, is the cost that is staying in the ending inventory, because we completely only use the $10 per unit. However, when we have that $6 extra, right? Remember, 6 times 5,000 units, that's $30,000 is sitting in my ending inventory, because here I used it all up, and here I have that $6 extra have not been sold yet. Let me go back here. I kind of like looking at overall. Here under this method, I took all my fixed manufacturing overhead, all 150, and used it up right away that year as a period cost. Where under absorption cost, I did not. I left that cost of $6 per unit for those 5,000 units sitting in the balance sheet. So I know, I'm sorry, I'm jumping around, but that's a good way of looking at it. So in the end of the day, your ending inventory value is higher because it have not been absorbed yet. And again, this is GAAP and this is not. All right. Another way of looking at or reconciling, take 5,000 units times 6, 30. So now under absorption is 120. All right. Let's look at a year 2. So that was year 1. So in year 2, number of units produced is 25,000. Number of units sold is 30. And units at beginning inventory is 5,000. So we're going for the same story, the same company. We're going to next year. Our ending inventory becomes our beginning inventory. And unit sales price is $30. Everything's still the same. $10 and $3, and we have the same manufacturing overhead and selling administrative expense. So now you obviously can sell 30 because you have 5 from the beginning plus 25, so you can sell all of it. So our ending inventory in year 2 is going to be 0. So again, the same story. Absorption costs $16 per unit because, again, we're producing the same number of units. Obviously, if you would produce different number of units, let's say you would produce 40,000, you take 150 divided by 40, but we're keeping it the same. This way we can really see how between 2 years the number reconciles it. And then under variable costing, my sales are 30,000 times $30, 900. Variable costing 30,000 times 10, 300. Variable selling administrative expense 30 times 3, 90,000. 300,000 plus 90,000 equals 390. Contribution margin is 510. Less fixed expense of 150 for this year. So we use all of the fixed manufacturing overhead expenses minus fixed selling expenses, and 510 minus 250 equals 260 under variable costing. Now, under absorption costing, we're back on using $16 because remember that 150 divided by 25,000 units produced, not sold, produced that year, would be included in a cost of goods sold. And my net operating income this year, sales minus cost of goods sold minus my period cost equal 230,000. So now we can look at our reconciliation and see that 30,000 unit from variable costing, right, net operating, plus 30,000 from last year equals my absorption costing. So what we did, we actually observed that cost. The cost is observed, and between 2 years, it comes down to 0. So the difference between 2 years. So first period absorption cost was 120, second 230, overall at 350. The second period, right? The second period, it was 260. So because we had a bigger volume of sales, right, we end up having a higher net income, and overall between 2 years are the same. The only reason this can be shown in this example the way it is because we're down to 0 inventory. If we were not down to 0 inventory, we still would have reconcilable differences. So that's the difference between variable costing and absorption costing. And this is kind of summary of the keys of how it's impacted. So if units produced and units sold are the same, you would see the same relationship between variable and absorption costing. It would have the same net income. And that's what we have seen in the previous chapters. Now, if units produced is higher than units sold, absorption costing, net income is going to be higher. And if units produced is less than sold, absorption cost would be less than variable. And then we have an inventory impact. Okay. So variable costing categorized cost is variable and fixed. So it's much easier to use this income statement for cost volume profit analysis. So it's CVP stands cost volume profit analysis. So as we moving forward, we're going to look at this and actually use this concept, how we just broke out the cost separately, to understand how different segments of the business work. Because absorption costing assigns fixed manufacturing overhead cost to unit produced $6 per unit, a portion of fixed manufacturing overhead resides in inventory. So we remember, doing the matching principle, we don't recognize expenses till we generate revenue. So it's delayed to be expensed till next year because it's sitting under your balance sheet as an asset. The potential result is positive operating income when number of units sold is less than the break-even point. So we kind of back into the break-even understanding. This is a couple important concepts that I want to make sure I reiterate. Variable costing income is only affected changes in unit sales, not affected by number of units produced. Okay, because we're looking only on the sales here. As a general rule, when sales go up, the net operating income goes up, and vice versa. Under absorption costing, which we used to from financial accounting, is influenced by change in units sold and units of production, right? So together. Net operating income can be increased simply by producing more units, even if those units are not sold, because we're observing the cost, and the cost is part of that. Okay. A little bit more theory here, just to make sure we understand this. Variable costing correctly identifies the additional variable costing incurred to make one more unit. So $10 per unit for Harvey company is also emphasis in impact of total fixed cost or profit. Because absorption costing assigns fixed manufacturing overhead cost to units produced, it gives impression that fixed manufacturing overhead is variable with respect to the number of units produced, but it's not. It's really not variable cost, because all we're doing is splitting the fixed cost by number of units produced that year. And as I used another example, let's say you produced 40, suddenly that number is actually going to go down, right? Because there's more units to absorb that cost of fixed cost. The result can be inappropriate pricing decision, product discontinued, or so on. So this is very important to make sure that if we isolate the decision making, right, because obviously more sales the cost per unit is less. By doing variable costing, we take that poor decision out of the equation. And I'm not saying all decisions are poor, but fixed cost only is low as how many units you have produced. So we're gonna prepare segment income statement that differential traceable fixed costs from common fixed costs and use to make decision. Let's talk a little bit about segment in general. I like to use Sendix, for example, because that's something hopefully people being in a grocery store, or could be any other food store, but a lot of stores you go in and they would have different departments. They'll have a deli, they might have a meat department, they might have a bakery. So each of those businesses are considered to be a segment. Most likely they'll have a manager, somebody who creates a menu, somebody who does buying for that department, and then they'll have a staff. They obviously have to use coolers, refrigerators. Bakers would be using ovens. So they have things that are absolutely related to preparation of that particular department work, or segment, as we say. Depends what business you're in. If you're in healthcare, and just think of a clinic, right? We have, if you go see a doctor, there would be a nurse station that maybe serves all the doctors, but then each doctor might be more specialized. And then what happens, the doctor wants to know more about you, they'll send you to do lab work. So lab work, or where the testing is done, that's a different place, right? So they may be going for blood test, so that would be a different segment. And maybe you have on-site lab that actually will determine results, right? And that would be another segment. Maybe they bring the blood samples from other locations, so that segment might be not just driven from your place. So you can keep extrapolating this data. It's not just manufacturing. So manufacturing, I can think of it making one TV and another TV model, but you can take this to a grocery store and say there's different segments. You can take this to the clinic, and I don't know, library, you have kids section, adult section, maybe educational section, movie section, media section. Movie and media, I'm thinking of the same, but I thought about music and wanted to combine them together in my mind. So regardless of that, you're breaking things down to segments. So that's kind of state of mind I want you to be in. So segment is any part of activity or organization about which a manager seeks cost, revenue, or profit data. This way you can see, does it make sense for me to keep bakery within a store? Or maybe I want to use a shop floor square footage for something else. So individual store, a service center, a sales territory, whatever it is the company chooses to break it through. And by the way, hopefully you either have taken or planning to take or really good at it Excel classes where you can do a lot of segment reporting by just using pivot tables and really dissect the data. I mean, this is technology. It's most amazing what you can do right now. You can really dissect data and the different channels and different avenues right now by breaking that in into per region, per product. Thing I can think of, when I was at Case Corporation, I mean, just think about they had construction and agriculture, right? So you can break it to two. You can break it to by regions, let's say North America, Asia, Europe, and then South America. In North America, you can have different regions. So I can say, okay, I just want to know, then I can break it down to the product, okay, I'm going to just do agricultural. So I have combines, tractors. So you can start breaking the data in a different segments just by breaking the data into different territories or places. So it's really neat. And actually the reason I brought Excel in, it definitely, like over the years, just since I had my career, have evolved even how many lines are allowed in Excel. But awesome tool. So it's something outside of this class, even though I do use Excel to show you some examples. I highly recommend, we don't teach it in this particular class, it's definitely awesome skill to have. So key to segment income statement is there's two keys to building segment statements. So we're going to use contribution format, which we've been using for managerial accounting. And because it separates fixed from variable cost, and we can really see where numbers are. And I kind of highlighted traceable fixed cost. I kind of mentioned it before, but this is where it really comes in. It's not direct cost, but traceable. Like it is traced to this department. So baking supervisor can be traced to baking department. Head of laboratory can be traced to the blood center. I mean, so whatever that is, you can really trace that particular person to it. So I can be traced to Lubar School, right? Because I teach business courses. So I am a traceable cost. So traceable fixed cost should be separated from common fixed cost to enable the calculation of a segment margin. So to help us to make good decisions. So traceable fixed costs arise because of existence of particular segment. And if it would not be there, it would disappear. So if we choose, we can just buy bakery, or we can centralize bakery, and it could be done in a central Sendex location. Suddenly, manager for baking department might not need to be there, so it would completely disappear. So for example, another example, Fritos produce manager of Pepsi Cola is traceable fixed cost of the Fritos business segment to Pepsi. Maintenance cost for the building for Boeing 747 are assembling traceable fixed cost to 747. So if it's done only in this building. Now, if maintenance cost supports other Boeing's models and this person goes from place to place, it's not traceable. But if we know it's just allocated to this particular product, that's where we at. Common fixed cost. I'm going to go back to the bathroom and the hallway, right? And different classes are taught, and you cannot trace that bathroom is only there because we're teaching the classroom in this room. So common fixed costs arise because overall operation of company would not disappear if any particular segment were eliminated. So going back to Sendex I go to has a bathroom up front. So even if they take out the baker's department, they still would like to have a bathroom available for the customers, right? Because that's something, they want to have there as a part of the service. So those things, and I know the reason I bring this because every location does have that, and hopefully we all use it. So we don't talk about it, but it's okay. So the whole idea is that common fixed costs still there. Regardless of it. So salary of CEO of General Motors, common fixed costs, regardless what they do for any divisions, they're going to still have that. The cost of heating a Safeway or Kruger, we are in the grocery store still, regardless of common cost of variable departments. So we still have to take care of it because we own that building. It's important to realize that traceable fixed cost of one segment may be common fixed cost for another segment, and we'll look at that. For example, landing fee paid to land an airplane at an airport is traceable to a particular flight, but it's not traceable to the first class, business class, and economy class passenger. So when the plane lands, they don't care how your plane is divided. And it's kind of interesting, actually, how airline industry works, how they rent. Some, have hubs and actually almost own the whole gate, and some would have to rent per flight or per gate costs. So those kind of things become very important if you're working for one of those companies and definitely want to do calculations. So traceable common costs, just to make sure for fixed costs, traceable, we're going to allocate it, and common cost, we're not going to allocate it. This way we can make good, clean decision if the division should still exist. For that purpose, we're going to use a demonstration company, Weber Incorporated, that has two divisions. So we have computer and television division, and we want to look at closely at television division income statement. So we're looking only on one right now, not both. Okay, so my television division have sales of 300,000, variable cost of goods sold 120, other variable expenses, total variable expenses 150, so 300 minus 150 gives me another 150 contribution margin. Traceable fixed expenses, traceable only, not common, 90,000 equals to my division margin, just division margin of 60,000. So just kind of to reiterate that cost of goods sold consists of variable manufacturing cost, and fixed and variable costs are listed in a separate location. So our approach of segment reporting uses the contribution format. So just want to make sure that we're using the same format. We're not doing the traditional financial statements. And contribution margin is computed by taking sales minus contribution costs. We've already done that. Now, this is going to go further down. So we have this overall sales of 300 for television, right? And it's right here. So what you just saw is here. What I'm also going to share with you, the computer division has the following data. So this is my $60,000 for division margin that we just broke down. And it's all located here. Now I'm giving you a computer division information. And if you add those two together, so we're going to add this, what equals our total company, right? And we do this for each number here. So 200 plus 300 equals 500 and so on. So our division margins are 100,000. But remember, we also have our common expenses that we said we're not going to allocate. This way we can make good decisions. So common fixed expense should not be allocated, and we're going to add them later on, and that's how they presented. So, on previous mention, fixed expenses are traceable to one segment, can become common fixed expenses if the common company is divided into smaller segments. So we're even going to go further down. Under television, under that one, so we have television computers. Now within television, we're going to start breaking down per product. Same thing I mentioned with Case Corporation, or CNH, they call right now Case New Holland. We have agricultural equipment and construction, and then under agricultural equipment, we have different products, right? We have combines, tractors, and so on. So we start breaking it down. So under television, we have regular and big screen, and this is my breakdown within them. So now we have a television, we have regular screen and big screen. We'll just take the data as it's given to us. And even though division margin is 60,000, now within those two products, we have a common expenses, right? So this is again the same combination. We took a regular cost plus big screen, and this is equals to this, and this is applies to it. But 10,000 of common expense, so fixed cost directly traced to television division, had to be spread out again. And this is just given to us. So this is not something you would actually have to do extensive research to understand the cost and allocations and so on. So maybe this is a salary of maintenance guy who actually supports both of them, and we cannot allocate to one or another. So once company prepares contribution margin segment income statement and can use the statement to make decisions to perform break-even analysis. I'm going to go back here for a second. If we would not allocate common expense or accidentally allocate this, for example, to big screen as a traceable fixed cost, it might look like big screen is not making any money. So how you allocate, right, that would completely bring this down to zero if this cost is over here. How you allocate shows how the bottom line looks like. And what I hear sometimes from students that they see in their companies is that, oh my God, I see my budget, I see my financials for performance of my team, and they put all this cost in there, and I don't know what they are, and we don't use those facilities. So sometimes it derives from some of those common expenses being maybe, nobody wants costs that they don't use in their bottom line. This way they look good. But they see this under absorption. But if you do the variable costing, you can eliminate that being there. All right. So segment income statement decision making. So what if we have 5% increase in sales? suddenly you can see the increases within a division, right? So this margin increased by 2,250. This one increased by 5,250. So we already know break-even analysis. We can do some of those calculations. But division margin overall increased by 2,500. So overall, that's a great decision because other costs did not go up. That's great. So how do we do break-even analysis? It's the same we did before, right? You can do this and allocate how we did this for multi-product, same concept. Calculate company-wide break-even point. We're going to do overall 170 plus 25, so 170 traceable fixed costs plus 25 divided by my contribution margin. The way we calculate contribution margin, we took 270 divided by 500. So we took a contribution margin divided by sales. So this is not new. This is a review. We've done this before. And then we can calculate a break-even point for each segment. We're using the same concept. So we're going to take contribution margin divided by sales, contribution margin by sales, and we can see that television, right, has a lower contribution margin. I mean, you can see it probably from here too. We knew that because we're questioning that the business will survive. And computer, no, this is going for the overall the company. This is going to be going all the way. This is not per product. This is more for whole companies together. And a computer has 0.6 contribution margin. So we have more money, 60 cents left after we're done covering our variable costs, where here we have only 50 cents left. So this looks better. Now, we have to notice that 25,000 of company-wide common fixed expenses are excluded from segment break-even calculation because common fixed expenses are not traceable. Even if we shut down computers, which I think television should be shut down, right? Because the one had the lower contribution margin, but I like both of them. They're both generating income. So we want to probably keep both. But we can see that we're not including that into calculation because we need to look at their performance regardless of common expense. All right. Omission cost. What costs we don't include? Research and development, product design, manufacturing, maybe retooling type of stuff, marketing, distribution, customer service. So costs assigned to segment should include all the costs attributed to the segment from the company entire value chain. But there might not be included into the product itself if it's overall operation related. So for example, if I'm developing a drug and I have research development related to the drug, yes, it's a research development related to a whole thing. But what if in a lot of labs do some research that they don't know if they're going to have a final product? They cannot allocate it to something yet. So that becomes kind of overall cost. So it is, you want to make sure you assign it and you look at the value chain as well as a whole. Inappropriate method for allocating costs. Let's talk about what not to do. So failure to trace costs directly. So costs that can be traced directly, sometimes it's too much work, we'll just leave it out as a common cost. So that's not good. Inappropriate allocation base. So something we talked about it before, let's say landscaping is it per job or per number of hours it takes me? Or should we do it based on per square footage of the yard? So that type of stuff, you would want to make sure that some companies allocate costs using something that relates to actual work-related activity. Drivers should be correct. Common costs should not be arbitrarily allocated to segments based on rationale that someone has to cover some costs. So it's like, okay, well, somebody should absorb this. This practice might make a profitable business segment appear to be unprofitable. And what happens, you might get rid of something that actually makes you money. Allocating common fixed costs force managers to be held accountable to costs they cannot control. And that is definitely not something you want to have. I'm going to reiterate this again. It's important to understand variable costing is great for segment reporting, understanding the cost and contribution margin and break-even of each segment, but it's not GAAP or IFRS International Financial Standards absorption cost required for those. Since absorption cost is required for external reporting, most companies also use it for internal reporting, then incurring additional cost of maintaining separate variable cost system. Remember, I mentioned the benefit of information you're getting from it have to outweigh the cost. There's another reason companies might be afraid that they have to report it on financial statements to externally, and that would give edge to competition to know their information per product. This is just a summary. Absorption costs, fixed manufacturing costs must be assigned to product to properly match revenue. Under variable costs, fixed manufacturing costs, our capacity costs will be incurred even though it's not produced. So we just recognize it that particular year. And this is something I mentioned already. We don't want to have or share sensitive data with the public, so sometimes they avoid using that approach, the variable one, because they say, well, you have that data, now you have to report it. But Reconcile's also will be applicable rules for consolidated reporting purposes, but obviously companies don't have to report on detail, but they might have to report based on some segments that they create. Depends on regulations, country, and so on. And that is end of our topic. And for this particular chapter, I just want to make sure that as you going through this data, you maybe go back and kind of look at the more simple examples or reference to your book. And those foundation problems in the end of a chapter are great too. But this is kind of building on the top of what you have already learned. And hopefully this was helpful for you. And I'll see you again.